We shall start this module by understanding how the Keynesian model emerged. The Great Depression of the 1930s resulted in deep impact on both economic and political outlook. The consequences of this event turned out in the general concept that governments can do their best to prevent such disasters from happening again. Even beyond this extreme case, there is a general agreement that a stable and predictable economic environment contributes substantially to social and economic welfare. By maintaining a stable macroeconomic environment, economic policy can thus contribute to economic growth and welfare. As a result, there emerged a Keynesian school of thought. Keynesian economics is a theory of total spending in the economy known as aggregate demand and its effects on output and inflation. In the late 1960s, the Keynesian view became increasingly challenged by monetarism. The debate between Keynesian and monetarists often focused on the effectiveness of policy instruments, with monetarists arguing for the ineffectiveness of fiscal tools and Keynesians believing in the superiority of fiscal stabilization policy. Nearly all Keynesian and monetarists now believe that both fiscal and monetary policy affect aggregate demand. Monetary policy can produce real effects on output and employment only if some prices are rigid. That is, nominal wages do not adjust instantly. But Keynesians believe that since prices are somewhat rigid, fluctuations in any component of spending like consumption, investment or government expenditures will cause output to fluctuate. If government spending increases, all other components of spending remain constant, then output will increase. Keynesians believe that prices, especially wages, respond slowly to changes in supply and demand shortages, resulting in periodic and surpluses, especially of labor. After studying this module, you shall be able to understand the Keynesian school of thought in macroeconomics, comprehend the concept of stabilization, understand principle of stabilization in the Keynesian context, differentiate between Keynesian notion of stabilization from non-Keynesian or monetarist notion of stabilization. Overview and test empirically the success of Keynesian notion of stabilization policy. Let us commence this module by understanding the term stabilization. A stabilization policy is a collection or set of measures introduced to stabilize a financial system or economy. The term can refer to policies which are resorted to the situations of business cycle, stabilization and crisis stabilization. In these cases, stabilization refers to discretionary policies to control the given situation. Stabilization can refer to correcting the normal behavior of the business cycle. It also refers to correcting inflation or deflation. In this case, the term generally refers to demand management by monetary and fiscal policy to reduce normal fluctuations and output. The policy changes in these circumstances are usually counter-cyclical, compensating for the predicted changes in employment and output to increase short-run and medium-run welfare. We shall now discuss the Keynesian framework. The Great Depression of the 1930s led to a profound influence on both economic and political thinking. The consequences of this event turned out evolved a general consensus that governments would do their best to prevent such disasters from happening again. But even beyond this extreme case, there is general agreement that a stable and predictable economic environment provided by government contributes substantially to social and economic welfare. In the short run, Households prefer to have economic stability with continuous employment and stable incomes, allowing them to maintain stable consumption over time. In the long run, unnecessary economic fluctuations can reduce growth, for example, by increasing the riskiness of investments. A highly volatile economic environment might also have a negative impact on the choice of education profiles and career paths. In short, by maintaining a stable macroeconomic environment, economic policy can thus contribute to economic growth and welfare. With evolution of faith in government to provide appropriate environment for growth and stability, there emerged a Keynesian school of thought. Keynesian economics is a theory of total spending in the economy called aggregate demand and its effects on output and inflation. However, in the late 1960s, the Keynesian view was majorly challenged by monetarism. The debate between Keynesians and monetarists often focused on the effectiveness of policy instruments, with monetarists arguing for the ineffectiveness of fiscal tools and Keynesians believing in the superiority of fiscal stabilization policy. Concerned about the possibility that monetary policy actions may themselves be a source of economic instability, Friedman argued that macroeconomic stability can be attained best by using an unconditional policy rule K% money growth rule. Friedman's basic underlying idea remains relevant that the economic system is ultimately self-stabilizing. But the available knowledge of economic system is too limited to comprehend short-run fluctuations. Robert E. Lucas assured that the welfare gains from stabilization policy are quite modest. According to the findings, the potential welfare gains from improved stabilization policy going beyond stability of monetary aggregates and nominal spending is likely to be small. Some economists like David and Christiana Romer suggested that severe recessions have been partly caused by over-ambitious macroeconomic policies. Now, let us learn about the principle of stabilization. First, Keynesian framework believes that aggregate demand is affected by both public and private, which would include mostly the decisions related to monetary and fiscal policies. Economists some decades ago argued about the relative strength of monetary and fiscal policies, with some Keynesians arguing that monetary policy is powerless and some monetarists arguing that fiscal policy is powerless. Nearly all Keynesians and monetarists now believe that both fiscal and monetary policies affect aggregate demand. Some of the economists also believe in debt neutrality, that the substitutions of government borrowing for taxes have no effects on total demand. Second, according to Keynesian theory, changes in aggregate demand have the greatest short-run effect on real output and employment and not on prices. This notion of Keynesian theory is depicted by the concept of Phillips curve. A Phillips curve shows inflation increasing gradually when unemployment falls. Keynesians believe that what is true about the short run cannot always be inferred from what can happen in long run. Monetary policy can result in real effects on output and employment only when prices are rigid or if nominal wages do not adjust instantly. So, Keynesian model generally either assumes rigid prices and wages, but rationalizing rigid prices is difficult, as microeconomics postulates real output and demand should not change if nominal prices rise and fall proportionately. But Keynesians argue that because prices are rigid, any change in consumption, investment or government expenditure that is component of spending would cause output to fluctuate. If government spending increases, keeping other components of spending constant, then output will increase and it will increase by a multiple of the original change in spending that caused it. For a Keynesian economics to work, however, the multiplier must be greater than 0. Third, Keynesians believe that prices, especially wages, respond very slowly to changes in supply and demand, resulting in short-term shortages and surpluses of labor. Even Milton Friedman acknowledged that there is limited amount of flexibility in prices and wages in United States. We shall now discuss the difference between Keynesian thought and others. First, Keynesians believe that unemployment as both high on average and too variable. They consider periods of recession or depression are economic maladies and not as efficient market responses to unattractive opportunities. This does not mean that Keynesians will resort to government spending, taxes and money supply every few months in order to keep the economy at full employment. This method of fine-tuning will not work because as there is a lag between the time that a change in policy is required and the time government recognizes this, then there is also a lag between when the government recognizes that a change in policy is required and when it takes action. The last lag occurs between the time that policy is changed and when changes affect the economy. This too can take many months, yet many Keynesian economists still believe that modest goal of stabilization is coarse, implying that an economist need not have detailed quantitative knowledge of lags to frame monetary policy when unemployment rate is very high. Second, some Keynesians are more concerned about tackling unemployment than about conquering inflation. They believe that the cost of low inflation are small. However, there are many anti-inflation Keynesians. Keynesians typically advocate more aggressively expansionist policies than non-Keynesians. Keynesians believe in aggressive government action to stabilize the economy. Is based on value judgment on the belief that macroeconomic fluctuations significantly reduce economic well-being and government is knowledgeable and capable enough to improve on free market. Third, New Classical believed that anticipated changes in the money supply do not affect real output. They believe in the notion that markets, even the labor market, adjust quickly to eliminate shortages and surpluses. Also that business cycles may turn out to be efficient. In the 1990s, the New Classical schools also came to accept the view that prices are sticky and that the labor market does not adjust as quickly as they previously thought. Fourth, many Keynesians are skeptical about the idea that people use all available information to form their expectations about economic policy. Keynesians follow stabilization policy taking into account that the prices are sticky under rational expectation models, but rational expectations do not consider rigid prices. Rational expectation models with sticky prices are thoroughly Keynesian by definition. Fifth, there exists a natural rate of unemployment in the long run. Prior to 1970, Keynesians believed that the long run level of unemployment depended on government policy and that the government could achieve a low unemployment rate by accepting a high but steady rate of inflation. In the late 1960s, Milton Friedman, a monetarist, and Columbia's Edmund Phillips, a Keynesian, rejected the idea of such a long-run trade-off on theoretical grounds. They argued that the only way the government could keep unemployment below what they called the natural rate was with macroeconomic policies that would continuously drive inflation higher and higher. In the long run, they argued the unemployment rate could not be below the natural rate. Soon thereafter, Keynesians like Robert Gordon presented empirical evidence for Friedman's and Phillips' view. Since 1972, Keynesians have integrated the natural rate of unemployment into their thinking. Sixth, new classical theory emphasizes the ability of a market economy to cure recessions by downward adjustments in wages and prices. The new classical economist of the mid-1970s attributed economic downturns to people's misperceptions about what was happening to relative prices such as real wages. Problems would arise, they argued, if people did not know the current price level or inflation rate. But such misperceptions should be fleeting and surely cannot be large in societies in which price indices are published monthly and the typical monetary inflation rate is less than 1%. Therefore, economic downturns by the early new classical view should be mild and brief. Yet, during the 1980s, most of the world's industrial economics endured deep and long recessions. Keynesian economics certainly predicts periods of persistent involuntary unemployment, though it may not be theoretically profound. Seventh, according to the early new classical theorists of the 1970s and 1980s, a correctly perceived decrease in the growth of the money supply should have only small effects, if any, on real output. Yet, when the Federal Reserve and the Bank of England announced that monetary policy would be tightened to fight inflation and then made good on their promises, severe recessions followed in each country. New classicals might claim that the tightening was unanticipated because people did not believe what the monetary authorities said. Old-fashioned Keynesian theory, which says that any monetary restriction is contractionary because firms and individuals are locked into fixed price contracts, not inflation adjusted ones, seems more consistent with actual events. Eighth, Harvard's Robert Barrow originated the idea of debt neutrality. Barrow argues that inflation, unemployment, real GNP and real national saving should not be affected by whether the government finances its spending with high taxes and low deficits or with low taxes and high deficits, because people are rational. He argues they will correctly perceive that low taxes and high deficits today must mean higher future taxes for them and their heirs. They will, Barrow argues, cut consumption and increase their saving by $1 for each dollar increase in future tax liabilities. Thus, a rise in private saving should offset any increase in the government's deficit. Keynesian's analysis, by contrast, sees an increased deficit with government spending held constant as an increase in aggregate demand. The massive US tax cuts between 1981 and 1984, it was observed that private saving rate did not rise. Real interest rates soared. With fiscal stimulus offset by monetary contraction, real GNP growth was approximately unaffected. Again, this all seems more consistent with Keynesian than with new classical theory. Ninth, finally, there was the European depression of the 1980s, the worst since the depression of the 1930s. Governments led by the British and German central banks decided to fight inflation with highly restrictive monetary and fiscal policies, confirming the Keynesian framework. The anti-inflation crusade was strengthened by the European monetary system, which in effect spread the stern German monetary policy all over Europe. The new classical school has no comparable explanation. New classicals and conservative economists in general argue that European governments interfere more heavily in labor markets with high unemployment benefits. For example, restrictions on firing workers. But at the same time, these interferences were existing in the early 1970s when unemployment was extremely low. Let us now summarize what we have learnt so far. First, a stabilization policy is a collection or set of measures introduced to stabilize a financial system or economy. The term can refer to policies which are resorted to the situations of business cycle stabilization and crisis stabilization. Second, the Great Depression of the 1930s led to a profound influence on both economic and political thinking. With evolution of faith in government to provide appropriate environment for growth and stability, there emerged a Keynesian school of thought, which is a theory of total spending. Third, however, in the late 1960s, the Keynesian view was majorly challenged by monetarism. The debate between Keynesians and monetarists often focused on the effectiveness of policy instruments, with monetarists arguing for the ineffectiveness of fiscal tools and Keynesians believing in the superiority of fiscal stabilization policy. Fourth, Keynesian framework believes that aggregate demand is affected by both public and private, include mostly the decisions related to monetary and fiscal policies. Fifth, according to Keynesian theory, changes in aggregate demand have the greatest short-run effect on real output and employment and not on prices. This notion of Keynesian theory is depicted by the concept of Phillips curve. Sixth, some Keynesians are more concerned about tackling unemployment than about conquering inflation. They believe that the cost of low inflation are small. However, there are many anti-inflation Keynesians. Keynesians typically advocate more aggressively expansionist policies than non-Keynesians. Seventh, Keynesians believe that prices, especially wages, respond very slowly to changes in supply and demand, resulting in short-term shortages and surpluses of labor. Eighth, new classical believe that anticipated changes in the money supply do not affect real output. They believe in the notion that markets, even the labor market, adjust quickly to eliminate shortages and surpluses. Ninth, many Keynesians are skeptical about the idea that people use all available information to form their expectations about economic policy. Rational expectations do not consider rigid prices. Rational expectation models with sticky prices are thoroughly Keynesian by definition. Thank you.